Good morning everyone. Today I would like to present about the corporate financing issues at Enron Corporation. Enron Corporation is an American energy, commodities and services company headquartered in Houston, Texas. The company was formed in 1985 through a merger between Houston Natural Gas and Enron. Enron is known for its accounting fraud scandal, which became one of the biggest scandals in business history. This issue led to Enron's bankruptcy in 2001. Next is corporate governance and ethical issues. Enron's demise was precipitated by a series of fraudulent practices driven by a culture of corporate greed and ethical lapses. The company employed aggressive accounting tactics, including mark-to-market accounting, which allowed it to report potential future profits immediately, often before these gains were realized. Additionally, Enron established numerous of balance sheet entities like special purpose entities (SPE) to obscure its financial obligation, presenting a misleadingly rosy financial picture to investors and regulators. There are several factors contributed to the fraud at Enron. Firstly, inaccurate financial reporting practices such as recording one-time sales as recurring revenue violated generally accepted accounting principles (GAAP). This misleading investors about the company's financial health. Secondly, a lack of independent oversight from external auditors and regulatory bodies such as Arthur Andersen and the Securities and Exchange Commission (SEC) allow fraudulent practices to persist unchecked. Moreover, weak corporate governance and a toxic management culture fostered an environment where ethical standards were compromised for short-term financial gain. Furthermore, Enron also used special purpose vehicles (SPV) to conduct obscure transactions with these companies, allowing Enron to borrow money without disclosing their true debts. The effects of Enron's collapse were far-reaching. Investors, including individual shareholders and pension funds, suffered significant financial losses. Thousands of employees lost their jobs and retirement savings, while public trust in corporations and financial markets were severely undermined. The scandal tarnished the reputations of Enron's executives, audit firms, and regulatory bodies, highlighting systemic flaws in corporate oversight and financial reporting. In response to the Enron scandal, governments and regulatory agencies implemented substantial reforms to strengthen corporate governance and enhance financial transparency. The Sarbanes-Oxley Act of 2002 stands as a landmark piece of legislation in the U.S., introducing stringent regulation to hold companies accountable for accurate financial reporting and to ensure independence in auditing. Increased scrutiny and enforcement by agencies like the SEC aim to prevent future corporate wrongdoing. Internationally, cooperation among governments and financial institutions bolstered efforts to combat cross-border financial crimes and fraud. In conclusion, the Enron scandal served as a stark reminder of the perils of unchecked corporate ambition and ethical compromise. It underscored the critical importance of integrity, transparency, and accountability in corporate governance. The reforms enacted in its consequences aim to restore investor confidence and strengthen regulatory oversight, emphasizing the need for ethical leadership and strong financial practices in safeguarding the interests of stakeholders. Ultimately, the lessons learned from Enron continue to shape corporate governance frameworks globally, striving to prevent similar disasters and preserve trust in the integrity of financial markets.